Hi there, everyone, and welcome to our FX Explained Macro Watch interview here. We are talking with Michael Pento. So early in his career, Michael worked on the floor of the New York Stock Exchange and was also a senior economist and vice president of the managed products division of Euro Pacific Capital. But now Michael is the president and founder of Pento's Portfolio Strategies, a registered investment advisory firm. He produces the weekly podcast called the Midweek Reality Check. He's host of the Pentonomics program, and author of a book, The Coming Bond Market Collapse. Kind of ominous there. He has been sharing his articles with us here at FX Spain for nearly 2 years now, and we really see strong whenever we put an article and report from Michael with his thought-provoking, insightful insights and reports. Welcome, Michael.
Thanks for having me on the show again, Steve. Good to be with you.
Yeah, it's wonderful to have you. Now, I've got a few questions in here. If it's okay with you, we'll just dive straight in with those, and you can let our readers and viewers take an insight further into how you're seeing markets right now and going forward.
Perfect.
Okay, so where do you see the short term? And when I'm talking short term, I'm talking about a 1 month kind of time horizon, but also then in the intermediate, like the longer term, 2 to 6 months outlook, and the directional risk for both the US equity markets and also the broader equity markets. And where do you see the election kind of sitting with that?
So I guess we have about 3 hours for the interview. So I call it kind of the deep state of Wall Street. They'll have some guy, they'll wheel out some guy and he'll say, well, my 6 month price target on the S&P is 3,600, but then I think 12 months it'll be 3,800, blah, 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 blah. I mean, they have no freaking idea where anything is going at all, even tomorrow. Yeah. So, rather than asking the weatherman what's the exact, how many clouds are going to be in the sky 6 months from now, this is what I do. I have a 20-point model. I have 10 components for inflation, deflation, dynamic, and I have 10 components for recession or growth dynamic. And I look at the trends in those components, all 20 of them, comes out to a diffusion index, comes out with a number, and that tells me where we're headed in the short term. So the next few weeks and months, that's what I'm most concerned about. Yep. And the reason why is because, I think human beings overestimate their powers of omniscience, and their predictive powers are horrific. Look at the Fed. I mean, this is a whole interview, but do you think the Fed really, and these are academics, they have in the Eccles building, there's just stuffed full of these stuffy academics, which are, I have a degree from Harvard and Yale. We have no clue. What they don't even know what inflation is, much less how to measure it. So rather than go out on my skis and tell you what's going to happen, a year from now, let's tell you what's happening now. So the model had predicted earlier this year, very early this year, January 24th to be exact, that we were headed for a period of disinflation and slowing growth on a second derivative basis. So the model adjusted appropriately. Then after the massive change from the Fed, okay, we're talking about March timeframe, right?
Yep.
Massive change from the Fed. I mean, Steve, they went from, if you remember back in the wake of the Great Recession, printing $85 billion per month.
Yeah.
The Fed's balance sheet increased by $3 trillion in a few months.
Yeah.
Let's compare. I mean, and not only that, but the Fed didn't just buy assets that were in the banking system. They bought, they bought the treasuries prior in the wake of the Great Recession. Now they were buying junk bonds. They were buying ETFs, bond ETFs, LQD, okay, for instance, HYG, for example. Sure. And they were buying these funds through BlackRock, and they were making loans to businesses, and they facilitated and monetized all of that helicopter money, the over $3 trillion that was given directly to individuals.
Yep.
So in that environment, what do? You have massive fiscal and monetary stimulus. So we're no longer going to be disinflating or recessing. We're going to probably be growing. So that's how the model changes. And it's a 20-point model. I have high yield LIBOR spreads, OAS spreads, 210 Treasury spreads, break-even spreads. It's a big model. But it was confirming that this is where we're headed. Now you ask me, here's the question. What about now?
Yeah.
Well, Steve, everybody spent all of their PPP loans, payroll protection program loans. All of the money has run out from those helicopter money checks that were delivered, Bernanke style from the helicopter. It wasn't Bernanke, it was Powell, but Bernanke was the one, telling you that's what would be done. $1,000 per every adult, $500 for a child. The enhanced unemployment, which was $600, and top of the state's benefit was around $350. You're almost making $1,000 a week sitting home doing nothing. That's gone. Okay, the president approved an additional $300. Most states haven't even processed that payment. Those payments are paid off of the FEMA fund, which is almost exhausted because of the hurricanes and the fires. So that money's almost gone. So there's no fiscal support whatsoever, really, at all. And then you think about, okay, so what about the Fed? So the Fed was printing, as I said, $3 trillion in a matter of a few months. And then you say, well, what about now? Steve, the Fed's balance sheet, and you won't hear this anywhere else except for here, unfortunately. People keep talking on, I was listening to CNBS a little while ago. The Fed has your back. The Fed's liquidity, blah, 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 blah. But here's the facts. And it's not like I'm some, forensic accountant that I figured out what the Fed was doing. You look at the Fed's balance sheet, it's actually been shrinking. They publish this every week. It's actually shrunk by $100 billion in the last few weeks. So that's a big change. Yeah. So you ask me what the model is predicting. It's predicting a period of, again, disinflation and a troubling period for the stock market. Right. And at least a significant slowdown, if not a recession in the economy. Now, that could all change predicated on who wins the White House November 3rd, if there isn't even a winner declared on November 3rd, which I happen to think this is going to be the most chaotic election this country has ever seen. So that's a problem in of itself.
Yeah.
Short term. So short term, I apologize for a long answer. Short term, disinflation, slowing growth, but who knows if they're ever going to pass another fiscal package? What is the Fed going to do next, and what's going to happen with the election? But I'll look at that. I look at that every day and adjust the portfolio accordingly.
Right. Gotcha. Yeah, I think you're right. I mean, it's Pandora's box, right? We're about to open with the election. You obviously have an incumbent who has, no matter what you think about him, he hasn't done anything normal, right? And that any other president has done. I think most supporters and those who are against him would probably say that. So the chances are we're going to get a non-normal election result and outcome, and what happens between then and inauguration day is going to be very interesting. And that, as you said, if you're getting these pointers already, as we move towards that, for me, there's a risk that is potentially the trigger that then starts the unwind. All these underlying themes, right, that you've spoken about, they are the core themes that are going to actually drive it lower in the longer term potentially. But I think you need that trigger. The market's always like something to start the rush for the exits, and that could be it. We potentially saw the start of it last week. I don't think we're quite there yet. I still think the market's probably got another leg to the upside. But then there is a real threat that as we move towards the election, markets, as they hate indecision, and we're going to get a whole batch of indecision. They're going to get a huge amount of indecision going into the election. So yeah, for me, that's a potential trigger for this potentially unwinding. I never thought, we were quite confident in the rally from our side, from March. Once we got the April rally, we thought we could go higher. I never thought we'd make new highs. I really didn't. And I think that things are going to get a lot uglier going forward. However, at the moment, you can't fight the price action, which is up. But then, as you say, there are, from your side, potential warnings, right?
Yeah. Oh, yeah. I mean, forgetting about the unconventional president that we have, I'll put it this way. The economy never really recovered. We still have 29. We got the information today. I don't know when you're going to put out this interview, but today it was being recorded Thursday morning. So we had the from the Department of Labor, the U.S. initial claims data, and continuing claims data. So I look at the continuing claims data to tell me what's happening with the real problem with this economy. It's not and again, I hate to be political because I'm an apolitical person. I don't like either party. I really don't. I voted for Mr. Trump, but I don't like either party. But Mr. Trump was saying that we have a not only a V-shaped recovery, but it's a strong V, whatever that means. Mr. President, there's 29.6 million people collecting some form of unemployment insurance. Okay, that number is rising, Steve, not going down. It's rising. And we think about We've got, I believe there's 155,000 companies that have closed their doors since February. This is data from Yelp. About 95,000 permanently have closed their doors. There's 3.4 million people who have now considered themselves permanently unemployed. That's the highest level since 2013. So when you think about the structure of the economy, it's extremely weak. But why was the stock market soaring to 100? This is the truth. 185%, the total market cap of equities, the valuation of stocks, 185% of GDP. Steve, that is light years higher than it's ever been before. So it was, think about 2000, March of 2000, which was an incredibly high figure for that metric, was 140, like 148, 150%.
Oh, way. I thought you was going to say it was even closer than that. That's amazing.
So we're way above that.
Yeah.
And in 2007, it was barely over 100. I think it was 110%. The average of that metric is 70% of GDP. So we're way over our skis. So the reason why we got to where we are in the stock market, as you mentioned, the Robinhood traders. I mean, if you give people who didn't make much money at all working, you gave them $1,000 a week to gamble with their new Robinhood account in the stock market. And if the Fed printed, Fed monetized all of that debt, you have to borrow it from the private sector. The Fed just printed it.
Here it is. Yeah.
Of course, the stock market's going to go up. But now that's all done. And now you're just sitting with the stock market that's hoping and praying for a vaccine, which is supposed to, by some act of serendipity, arrive on November 1st. But even if it does, Steve, how many people? I don't know. I know a lot of people. I have met a very, very small percentage of people who are going to be the first in line to take this vaccine that was developed at what I call hyper warp speed. I mean, what for? What would you do that for? Why would you risk? I mean, normally vaccines take decades to produce. Decades. I'll say a decade. I don't use a hyper. Years and years and years, perhaps as long as a decade. You remember the massive AIDS crisis that we had in the 80s, right, Steve?
Yeah. No.
What is the vaccine? And there was money thrown out that horrific disease. What vaccine was ever created for AIDS?
I know. There's never
been a vaccine.
That's one vaccine, and that's been successful for chickenpox, come from smallpox centuries ago, and the guy just happened upon it. That was just happened upon. It's not been successful, and you can chuck as much money as you want. If it's not there, if it's not attainable, it's not attainable.
Well, maybe it is, and maybe it isn't. But I know for sure that to distribute a vaccine globally that is proven to be safe and effective is something that's going to be a matter of years, not months.
Agreed.
People just won't take it. So if Wall Street's hoping that by November 1st, a vaccine is going to be out and distributed and eradicating COVID-19, but it's just not going to happen. So what is Wall Street clinging to? Well, it's clinging to the hope that there's a massive, another $3 trillion fiscal stimulus package that gets printed and monetized by the Fed. And that ain't happening either. So now you just have the economy, which is still, 29.6 million and rising unemployment. That means the economy is very unhealthy. You're left behind with the scars of COVID-19, beyond, of course, the horrific deaths that have occurred. I think it's 190 something thousand here in the United States. Besides that, the economic scars are devastating, which is, as I said, 3.4 million people permanently unemployed, newly unemployed people that find themselves permanently unemployed, the 29.6 million people still unemployed getting insurance, the massive business closures that are permanent in nature. So, and by the way, and one more thing, the balance sheet destruction that has occurred from not only the governments around the world, but from corporations around the world who had to take on all of this debt just to stay afloat. And they were already debt disabled before the Wuhan virus broke out.
Yeah, yeah.
Okay, this was the nucleus of the crisis, was this massive debt to GDP ratio that we had from on the corporate side, and now that's been exacerbated. So the idea that we're going to have some booming economy anytime soon is ridiculous. Sorry.
Yeah, no, I agree with a lot of what you said there, Michael, and on board with a lot of that. I think there's a real risk going forward that we have as well. I mean, something again, we don't want to make it too political in here, but I mean, with these kind of percentages on unemployment, if they stay long term, okay, you've got COVID to kind of, it's a a unique kind of thing we're going through in here at the moment, unprecedented times, as everyone likes to say. But then, I remember back in the early 80s when I was relatively young in the UK, and we went through this kind of deindustrialization, that Margaret Thatcher was closing the mines. And when you get to 10% unemployment, and if it's over a significant amount of time, then you get social unrest. And we're already seeing pockets of that, right? We're seeing a little bit of it in Europe. You've seen a lot more of it in the US. And that is not the basis from which you build a strong economy and see the stock market on all-time highs at the levels to GDP that you said. I mean, it just doesn't add up.
Correct.
If I can shift this along to the bond markets, because I know you've got your book, The Coming Bond Market Collapse. In here, we've been sitting, well, let's face it, 20 plus years in Japan at zero yields, right? We've been in Europe, negative yields in Europe since the global financial crisis, pretty much, and actually going just not long after that. So let's say over a decade now of negative yields in Europe, and just not managed to move away from those. UK, we're sitting around 1% and below. And the US, obviously, now where you guys are, sitting around 0% of the short end effectively, and dithering around either side of 1% of the longer end. Is that a bubble waiting to burst as well in our particular, or is the inflation, this average inflation target, just basically the Fed saying, well, that's our escape route, we can let inflation run a little bit? But how much is a little bit?
Wow, you got the most detailed questions I've ever.
I'm sorry. Okay.
I love it. No, it's
Okay.
it's wonderful. It's just it's hard for me to try to compress them into concise statements.
Okay.
So is there a
market bubble?
Okay, so obviously, since I wrote a book about when I wrote the book in 2012, I never dreamed that 8 years later there'd be $15 trillion worth of debt around the world with a minus sign in front of it. I mean, negative yielding debt. So you defer. See, I save money. I defer my consumption. I really don't want to spend this money right now. I want to save my money. I'm going to give it to somebody else and defer. That's what savings is, deferred consumption. And then maybe sometime down the road, they'll give me my money back minus some percentage.
Go figure.
What? Oh, that's nominal, Steve. That doesn't account for the fact that every central banker on the planet has an asinine 2% plus now inflation target. Mr. Powell came out and he says, since we missed our inflation target for a decade or so, that was 2%. Now we want our inflation target to be more than 2% for some period of time. That's equal to the amount of time it was below 2%. But he didn't quite, since they have no idea what how to measure inflation or what causes inflation, he didn't leave us with any method of getting there. And the only way you're going to get inflation rising above 2.5% for a very long time, the way, and I always say this, the way the Fed measures it, because I already think we're way above 2.5% inflation if you threw asset prices in there and counted real estate prices accurately.
Yeah.
And even medical costs and college costs and all, but they don't know. They take out everything, but they measure it by its core PCE function.
Yep.
Okay, so personal consumption expenditure price index, a core, not taking out food and energy. So the only way they're going to get there above 2.5% is if there's this massive drop of helicopter money that the Fed gets to monetize, which there isn't right now. So I think look at the price of oil. I mean, if we really were heading back towards 2% and above 2%, then energy prices wouldn't be collapsing the way they are. We're way below 40 on WTI. I think we're $37 a barrel on WTI.
Yeah.
So that's not going to get us there. So we have this asinine inflation on all of that. So private sector debt, public sector debt, about 370% of GDP. It's an all-time record high of debt. And this debt exists in the context of record low yields. This is antithetical. It's a conflicting thesis here that you could flood the world with much more debt than it's ever seen before, and yet your borrowing costs are near zero and below zero.
Yeah.
And the only way that concept has any legs, any traction, is if there is deflating in a disinflation or deflation environment. This is the only tenable argument for there to be rates that low. And then what do we just talk about? What does every central banker on the planet want? And will continue to monetize debt until it gets there. They all want inflation. They all want rising inflation. Here's the problem, Steve, and you remember back in the United States. So central bankers really have a very difficult time with inflation. They think they can easily control it, but it's very intractable. It's an intractable thing. You know, as I said before, Powell can't really meet his inflation targets. He consistently underreaches them. But when you think about the Fed in the 70s, in the late 70s, early 80s, the Fed and the government managed to get inflation going, but inflation didn't stop at 2.5% and then magically die. You know, Mr. Volcker had to take the Fed funds rate to 20% to kill CPI inflation, which was 15%. Yeah. Now, I can tell you that there wasn't a central banker, Arthur Burns or any central banker on the planet, that ever wanted 15% inflation, but it got there. And the reason why it got there is because inflation is all about the market's realization or assessment of where your fiat dollars purchasing power is going. Yeah. And if the market loses faith in that currency's purchasing power, you can't turn that around on the dime. No. You just can't. So I don't think it's going to be very easy to get to 2.5 the way the Fed measures it. If there is a massive helicopter drop, let's talk about the election. I know this is one of the things you wanted to ask me. Let's just suppose that there's a massive Democratic sweep in the United States on November 3rd, and the election finally gets sorted out over after we have, Mr. Trump has to get dragged out of the White House. Oh my God, it's good.
Having pardoned himself.
And so suppose the Senate goes Democrat and the Congress, the House stays Democrat. So you have a sweep of Democrat. Yeah. That's why you can't ask me what the stock market's going to do, because this is a totally different dynamic.
Yeah, sure.
Gridlock is a problem now because the market needs this stimulus to keep up where it is, and it's not going to get it gridlock. But if you do get a triumvirate of Democratic power, you're going to see a much higher level of stagflation, and the market's going to be in a big problem, because I believe Mr. Biden is going to raise corporate taxes, and he'll be able to do it with the Senate and the Congress. And then there's going to be, you're going to get AOC, okay, her policy. You get Bernie Sanders' policy of helicopter money. So, I know Kamala Harris is the vice president, but AOC is part of that cabal there. Right. Now, Kamala Harris has stated that she wants $120,000 of helicopter money to each family, worth of universal basic income. Yeah, $120,000 per year of universal basic income.
Why would you want?
She's avowed that in writing. So if you pay an American family $120,000 a year to lay fallow and not produce anything, oh boy. And then you raise corporate taxes, you're going to have stagflation like they make the 70s blush. And then you're going to get your inflation. And then you're going to see destruction in the bond market like we've never seen before. Yeah. Boy, oh boy. And I'll tell you one thing, Steve, you don't want to have your typical, let's just wirehouse firm saying, the 60-40% portfolio will have you protected. Well, yeah, not when both bonds and stocks are in a massive bubble. Good luck with that.
Yeah. I guess that's when you buy a safe, right? And put the cash. That could be the emergence of Bitcoin, right? I don't want to go on to Bitcoin because that opens the whole world. But you talked about that they're the US dollar and the destruction of effectively confidence in it, right? Inflation's all about confidence and perception. And then the real issue, is, as you said there, you can't just put the brakes on. It's not easily turned around. They've been trying for, let's face it, I said right there at the heads up, when I set the stage with it, Japan's been trying for 20 plus years. Yeah. Europe's now been trying for 10 plus. Yeah, no, but then when it comes, it's just going to come with as like a beast. And you don't. It's not going to go to 2.5, 3 and stop, right? And then all of a sudden, companies will be infighting, prices will be going up. They'll be jacking prices up to try and get what they can. And as you say, if you get some kind of, UBI at that kind of level, $120,000, I see what you probably buy. You probably buy initially shares in Disneyland because they're all going to be going there, right? But then it all ends in tears, as you say. And then the tools then. Now, they've kind of had the tools on the central bank side evaporate in here over the past 2 decades, and now we're back down to zero rates. You're just printing money, pumping that money into the system, and almost now back themselves into a corner. You get stagflation, and as that's just the worst scenario because you have to put up rates, but you don't want to put up rates, right? And then, as you say, we had rates going to, in the UK and Europe is the same thing, double-digit rates. People can't. What does it do to mortgages? How do you get a mortgage on 10, 15? My parents, when they bought their first house, mortgage rates are up at 10% in the UK, right? 10%. I've had a mortgage for a lot of my life. I haven't paid more than 3 or 4.
When your sovereign debt, when the yield on the sovereign debt is taken to mid-double, so let's say it goes to like 15%, in the mid-teens. What do you think is going to happen to the high yield market? By the way, 20% of companies in the world are zombie companies, and they can't afford to pay interest on their debt. So if the sovereign debt is 15%, your high yield debt's going to go to 25%. If your borrowing costs go from 5%, which is where they are now, to 25%, how many of these companies are going to be around?
Yeah.
I mean, you're talking about, and here's the thing, Steve. I'm glad I get a chance to say this. Once you start one of these programs, these universal basic income programs, both parties seem to be wedded to them. It's very hard to tell people, I gave you your $1,000, just helicopter money, $1,000 per adult, $500 per child, and we're not going to do it again. Both parties, Republicans and Democrats, want to do the same thing again. So when is it going to be a good time to stop that? When is it? Here's another thing. It was, remember, in the wake of the Great Recession, Ben Bernanke said, "We have the courage to act, the courage to print, the courage to, please." Al Capone had courage too. So, remember Bernanke said these are emergency measures. Yellen follows him. These are emergency measures. Why are we doing that again? I thought it was emergency. Well, you say, well, it's because it's the pandemic, Mr. Pento. Are you crazy? Well, I will be quick to remind you that the Fed went back into QE in 2019. Yeah. Okay? Because the repo market froze. So I don't want to hear anybody tell me that this is just a QE because it's necessary. But no. Once you start these programs, be they 0% interest rates, you mentioned Japan and Europe. Years and years in Europe, even longer in Japan. Even longer, I mean, not longer, but very long time here in the United States. That's been permanent. So permanently addicted to ZERP, permanently addicted to QE, Japan, Europe, the United States, and permanently addicted to universal basic income. That's how you get your bond bubble to burst. And wow, boy, when it bursts, watch out. Because you're going to have yield spike. When yields, by the way, in 1980, when Mr. Volcker took the Fed funds rate to 20%, the stock market was maybe 40%. Stock market valuation was maybe 40% of GDP. U.S. national debt was maybe 35 or somewhere around the same level, very low. When the U.S. national debt is 136% of GDP, when the stock market's 180% of GDP, you take interest rates that high, you're going to destroy real estate. You're going to destroy the stock market. You're going to destroy the economy like we've never seen before. So you really can never take interest rates that high. So what does that mean? That means central banks have to completely create completely monetize and control. They call that yield curve suppression, which is the next step for the Fed. How long is that going to last? Because you can buy, by the way, you can print money and buy sovereign debt, but are you going to also buy municipal bonds? Are you going to buy investment grade bonds? Are you going to buy junk bonds? And are you going to continue that the rest of your life? So do you want to hyperinflate? You're going to hyperinflate the entire economy to keep interest rates low? Boy, oh boy, this is the twilight zone. Rod Sterling could never have imagined this.
Brilliant. Look, I'm really conscious of time. I just want to ask you one question, and take as long as you want, but I'm aware of the time. I'm going to ask you about what happens, in whatever kind of time frame you want to put on it, short to intermediate term, for the dollar. We've seen a lot of dollar weakness. It's perceived as this safe haven. But, back when COVID broke, there was that huge rush into the dollars, and people couldn't get enough of the dollar, right? And my feeling is, at the moment, I see US dollar probably re-weakening, and we stay in this kind of bubble mentality. But at some point, does the dollar catch a bid because it's seen as really as an ultimate safe haven when this is all destroyed, or do we go somewhere else? Is there anywhere to go anymore?
It's like watching a tennis match. So it's the dollar strengthens because there was a liquidity crisis in March. That's what happens when you have a reversal of carry trades. The yen strengthens and the dollar strengthens. And then what happens? Well, then the Fed comes out and this massive QE program, which dwarfs that of what happened in Europe. So then the dollar falls, the euro rises, and then Madame Lagarde says, "Oh, this can't happen. So we're going to just whack the crap out of the euro." And then the euro falls, the dollar rises. So I just see this seesaw, but I don't think the dollars. I think the dollars will be more or less directionless, with maybe a slight downward trend to it against other fiat currencies. But here's the most important part about this. I think all fiat currencies are going to get destroyed against hard assets. So you think precious metals and real estate and commodities in general. So those are the big three. I think that's the real question is, what is the direction of fiat currencies? And it's much, much lower against hard assets. Much less, and that doesn't mean that the yen can't weaken against the euro or against the dollar. That what is going to happen with the faith in fiat currencies, and that's another crash that's coming.
Okay, wonderful. Well, I'm going to wrap it up there. Taking a lot of your time, but I really do appreciate it's been. I've had fun as well as I feel I've learned something as well, which I love to learn all the time. 50 years old now, still learning. So I've learned something. You've been really insightful. I'm sure anyone watching and on this video is going to really take some big takeaways for you, insights there. And just pleasure speaking to you, and many thanks again.
Well, if it was any good, this interview is because of your very insightful and in-depth questions. Thank you, Steve.
There you go. You're welcome. Take care. So traders, don't forget to catch us on the next FX Explained Macro Watch and all the great content on fxexplained.co.uk.